Hello everyone and welcome to the latest edition of Insurance Business TV and a return of our Professional Risks Power Panel. Joining us again, we have Candace Pietras. She is Professional Practice Leader at Purves Redmond Limited. And joining us for the panel debut, we have Mike Lawton, Regional Practice Leader, Management Liability at Gallagher, and Jelena Stojanovic, Practice Leader for Professional Liability at Aon. So welcome everyone, and let's start with a bit of an overview. According to a WTW report, professional liability rates in the London market have dropped by between 5 and 10% in recent months, and there has been an increase in underwriter appetite. So does this reflect what you've seen in the Canadian market, and what changes have you noted since the turn of the year? Candace, I'll start with you.
We've noticed that we've entered a shoulder market, which means the insurance market is unpredictable. Some insurers are providing reductions, some incumbent insurers are not. So what we've noticed that's of change is that insurers are now approaching us for the first time in a year, asking for new business and being more willing to negotiate. And with more competition does naturally come lower rates. And while I don't want to lead the softening in the market, we have to do the best for our clients and market more often than not.
It's an interesting start there. An unpredictable market is how Candace described it, Jelena. Are you seeing that the pricing is getting more competitive?
We are indeed seeing pricing getting more competitive, and we do have more renewal options for our clients. There is still less interest in the more challenging risks. So when we think of condos, structural steel contractors, oil and gas exposure, stadiums, they're still trickier to place because the markets are still quite conservative on the riskier business. In terms of Canadian rates, we are seeing reductions on annual business where renewals are typically flat to negative 5% on the clean accounts. And keep in mind that an entity's loss history remains a very important factor in the underwriting process. For construction projects, we have seen additional insurers interested in providing capacity. However, those markets that experienced high losses in the past years, they have increased their rates overall year to year. So in Canada, we are seeing additional capacity. There's an increase in underwriting appetite as well. From conversations we had with insurers, they're all looking to grow between 10 and 20% this year. So that lines up with what Candace said. New markets like Volante are preparing to enter the space, and there is some of the older dormant capacity that we haven't seen in a while getting redeployed through MGAs. So I find that quite interesting.
Yeah, definitely an interesting market right now. But of course, stats are always old as soon as they're published. Mike, bring us up to date. What have you seen in Q2?
Yeah, I'd say the 5 to 10% reductions were more of a Q1 play. We saw lots of markets entering the year hoping for flat renewals. That was not a lasting strategy, as we saw hungry underwriters coming to the table, looking to make deals on big cherry accounts. We'd see a lot of downward pressure available. And if it was a clean loss ratio, lots of happy underwriters to pick it up and take off where the last underwriter let off. And as we've moved into Q2, even sort of greater reductions, 15, 20% on these great accounts that we have.
Well, that's sort of an overview of the market, but let's zoom in on some of the specific areas now if we can. According to a recent brokerage report, A&E professional liability rates are likely to increase for a third consecutive year due to social and economic inflation, heightened risks with specific project types, of course. So how would you assess the A&E space currently? What tips would you offer to brokers looking to help their clients who are facing these potentially higher rates? What do you think, Jelena?
So we do see social inflation in the US as claim settlements and jury verdicts are escalating. Particularly, there was a significant increase on third-party auto claims in the US where allegations were made that contractors and design firms failed in their professional duties, such as by negligently designing detours or providing inadequate safety warnings. We are seeing more verdicts over $5 million, and those are impacting the cost of insurance. In addition, there is deterioration of portfolios from claims from several years ago, which means the market is now likely to soften more within the next year or two. In Canada, rates on annual policies are flat to minus 5% this year. That said, we do expect there to be a larger push of claims onto annual policies of architects and engineers. And this is due to the cost of the project-specific policies, We see a lot of owners that are getting quotes for medium-sized projects, and then they're balking at the premiums and asking the architects and engineers to carry the risks on their annual programs. So this will inevitably lead to more claims on those annual programs and then higher premiums down the road. In terms of the A&E project-specific space, there is an increase in the capacity for projects under $1 billion, particularly the simpler vertical builds. For these projects, there are quite a few markets interested in offering primary terms. And of course, there are a lot of markets interested in offering excess terms. For projects over $1 billion, and particularly when we're looking at the large, complex civil projects that are delivered on a design build basis, there are only a few markets willing to look at these from a primary basis for A&E coverage. So the premiums are such that there's very little risk transfer taking place, premiums being 65 to even 95% rate on line for the primary 5 million outside of Quebec, with even higher rates possibly in Quebec because of defense outside limits still applying to multi-year policies. And as we know, defense costs are very substantial on both project and annual policies. In terms of retentions, these vary widely still, from very reasonable ones at $50,000, $100,000 per claim to multi-million-dollar retentions, which we're seeing from some US insurers. So while we do expect capacity to increase in the near future, we're not seeing anything close to the levels from 4 or 5 years ago when $100 million towers were available on projects. The procurement models do come into play. The markets are more conservative when it comes to P3's design builds, largely because of the low percentage of design that's completed prior to the contractor committing to the fixed price. So insurers are more optimistic about the collaborative model, such as a progressive design build. And unlike the design build model, where the bids are placed at as low as 15% completed design, with progressive design build, the contractors will take the design during phase 1 to a minimum level of completion, such as 60 to 80% prior to providing their target price to the owner. So as this delivery method, it's fairly new to Canada and even the US, where it's been used over the last 2-3 years. So we're still going to see the results of it years down the road, but intuitively, we do expect less claims.
Okay, that's a great way to set the scene for us. And Mike, to bring you into the conversation as well. I mean, with a market like the one that Jelena's described, I guess it's putting more emphasis on checks and balances. Would you say so?
100%, Paul. Yes. I think at this stage in the market, you have to spend a lot of time making sure underwriters are receiving a clear message of what the clients are doing to make themselves best in class, whether it's a strategy for climate change, using catastrophic loss data to show that they're, outside of these fire zones, and just working on relationships is really a big thing, whether it's going to London with our clients to introduce to underwriters or having underwriter calls with Canadians. Making sure that relationship is a big factor is key right now. As they noted, there's not a ton of markets, there's limited capacity. So making sure that your client stands out from the rest of the pack, I think is a really important aspect in this current market.
Yeah, and Candace as well. I mean, you and I were speaking off camera a little bit prior to this recording, and you said that you actually disagree with some of these statistics. Is that right?
Been an A&E specialist for a long time, and while I really hoped that the rates would remain flat, I've noticed that they've really begun to reduce. And it depends on the circumstance. And of course, I assume that the client has a loss ratio under 40% or a relatively good one. But I've noticed that when we compete with other brokers or we do a full marketing, that clients are getting an incredible benefit right now in terms of premium reductions. Everyone's hungry to grow. And as such, I've seen reductions range from 25%, sometimes 40%. And the last thing I want is for the rates to go into the death spiral for other lines, because it's difficult to recover from that. But the lesson I would impart to other brokers would be, you have no choice. You have to market your better clients right now, or they will be marketing without you. And in the long term, I really do think that brokers need to work with their clients to improve quality control and contracts. Does the client have a reasonable limitation of liability? Do they waive consequential damages, at least in their own engineering services agreement? Are they expected to defend clients when they sign client contracts? That's not acceptable and not insurable. So these are small ways to distinguish a client from their competitors, and that is by really working with them, with legal counsel, of course, to improve their engineering service contract.
Well, let's switch from the engineering area across to the healthcare sector if we can. Of course, liability risks in that particular area have evolved significantly since the COVID-19 pandemic, shaped, of course, by many factors, including regulatory demands, social inflation, emerging trends, of course, like telemedicine and digital health. So how are you adjusting your approach to this segment of the market, and how are you keeping pace with its developments, Mike?
Yeah, this is a market that, again, is in quite a state of flux. Really stepped up to relevance during COVID and remains as shifting to digital sort of means continues. We found during the pandemic that there was pretty limited capacity. The pricing was quite high, and insureds were in a tough spot choosing what is an adequate limit for their programs while factoring in what's available in their budgets. Now that we see the prices dropping, it makes it much more interesting conversation with the insureds of whether they want to reinvest those savings into higher limits or just tuck those away for a rainy day. Recent claims coming to settlement, like Life Labs, obviously London Drugs has been in the news a lot, getting a lot of attention. Even the First Nations Health Authority really shine some light onto what programs should be looking like. You look at Life Labs with, what is about $550 after lawyer fees per client getting, or per customer being sent out. If you're in the multi-million sort of number of patients that could be affected, this is a huge number. Following a 4-year legal battle, significant cyber incident response costs. So thinking a $10 million program is adequate is a bit false. Then you look at London Drugs, the business interruption impact that they had from their claim is huge. And then obviously the ransomware and extortion continues to be a key threat for these. So taking time to look through all the different avenues to your exposures and making sure you have a program that adequately reflects what your exposure could look like, I think is paramount right now. Otherwise, with a small balance sheet, a lot of companies could be left in the dust.
Ah, there you go. Left in the dust. Those are strong words from Mike. Candace, are you having to make some changes to E&O policies on the back of all of this?
We've noticed that the healthcare sector has certainly moved online. And where I'd like to make a comment, and it'll be brief, and it's just that to remind people that E&O policies can have multiple insuring agreements. So don't forget to add technology services or technology products to medical malpractice policies. You don't have to sell separate policies, of course, unless separate limits are desired, but not to forget about the online aspect to the risk, and certainly quote this along with your standard E&O.
Well, we've looked at a couple of niche markets there, but tell me if you've seen any increased interest in any other product types. Let's widen the professional risk net if we can. Are there any products that you feel brokers should be more actively selling to their clients? And yeah, this can include potentially anything, I suppose. Jelena, what would you highlight?
So going back to construction professional liability, I would say that contractors E&O is definitely up there. There is a misconception that contractors E&O applies only to design build contractors and projects. In fact, professional services covered by contractors E&O policy are much broader and cover more than pure design. Contractors often assume the responsibility for design assist, constructability reviews, delegated design, construction management, to name a few. So all of these services are professional in nature, and they would be excluded under the commercial general liability policy, and they could result in significant financial losses. So in addition, owners and contractors need to keep in mind that designers generally carry low limits of liability, between 2 million and 5 million on average, with annual aggregates which cover all of their work. They also limit their liability contractually, so that leaves the risk above the liability cap on the owner or the contractor for them to assume. And this risk can be covered off by the contractor's policy or the owner's professional liability policy. Another product is tech E&O. I would say that this is an exposure that needs to be reviewed with clients. The concern is the overlap between technology products and services and the professional liability. So what we're seeing with a lot of clients, they are themselves developing technology and offering it as a pure service to their clients. So when you're reviewing the professional liability policies, you have to be careful because some professional liability policies have separate insuring agreements for technology products and services, and others only provide the coverage to the extent that the technology is offered in conjunction with the other covered professional services. So that can be an issue. As I said before, the technology is offered on a standalone basis very often.
Okay, so Jelena's suggestion for us is the contractor space. Mike, what would you highlight?
I think the policy that we're encouraging our customers to look at is Side A DIC, directors and officers cover, the difference in conditions. It's not an expensive policy, and I think people underestimate just how powerful it is in the professional space, digging into the professional services exclusion that will be found on all D&O policies. Seeing if it's an absolute exclusion, a for language, I think is really important. But then shoring up their program with this IDIC policy is really compelling right now. It's very broad, contains no exclusions, specifically professional liability exclusion. Really shores up the directors and officers' personal insurance coverage, and provides some additional features like excess sublimits, has no insured versus insured exclusion. So it's a cost-effective policy that really shores up directors and officers program.
Okay, so we've had two very different answers so far. Candace, are you going to make it 3 for 3?
Absolutely, have to be the contrarian. So the one policy that we see sold to clients, but that could be improved, is cyber. People are selling it now. That's wonderful. The issue is clients aren't buying enough limit. And so in the last couple of years, they blamed the E&O market for eroding all their budgets. But that should no longer, or should be lesser of the case. That being said, in general, I do think brokers are very good at selling products to their clients. What brokers now need to do is they need to distinguish themselves to their clients, and they need to help their clients distinguish them from their competition. And that can be done by providing value-added services, whether that be newsletters, contract reviews, business continuity planning. Clients will be very happy with this softening market, but they may question why they paid high premiums in the past. So you have to remind them about your expertise and your services. And I think that's important for all brokers over the next year.
Yeah, excellent tips. And we're going to add a little bit of value of our own, because we're going to leave our retail broker audience with a tip based on activity that each of you have seen in the professional risk space since the turn of the year. So Candace, while you're on a roll, I'll come to you for the first tip.
My advice would be to continuously test the market space for options. Shop around, not just for the rates, but for coverage options, and start spending your extra time doing wording comparisons between insurers. Always looking for creative options for the client.
Okay, so test the marketplace is Candace's advice. Jelena, have you got any tips for our brokers out there?
Yeah, I completely agree with Candace. And along that line, I have seen some Lloyd's syndicates try to impose a subcontractor warranty on contractors' E&O policies. And these warranties are very onerous. So the language should be reviewed very carefully, because strict compliance with the warranty is a condition which is precedent to coverage. So insurers will typically agree to more reasonable language. And if not, I definitely suggest remarketing the account. And one more, on the project-specific front, what I have seen recently, a couple of times I was asked to place annual project-specific policies. My recommendation is to negotiate this out of the contract right at the onset, because while annual policies could be fine for a 12-month project, they're not suitable for larger multi-year projects, and they can leave you not being able to renew the coverage.
Okay, so we've had two very strong tips so far. Mike, that means the pressure is on for the final word from you.
Yeah, I would say don't let your foot off the gas pedal. It's been a tough 4 years, a lot of ups and downs, but now is not the time to get complacent. Make sure you have specialists and parachuted into your different coverage lines to not one person is running with everything. And then kind of the last tip would be, get together with your clients, take them out for lunch, have a meeting. We've come out of COVID and the opportunity to refresh those relationships. This is a people industry. Go make friends again, have some fun.
Yeah, fantastic stuff. A huge thanks to our power panel. And remember, they will be back together again in Q3 for more thoughts on the state of the market. Until then, make sure you keep it right here on Insurance Business TV.